Holy, Starbucks is down nearly 30% year over year. Is this a buying opportunity, folks? Their stock value has taken a pretty big hit. You might be wondering, what's the deal? To get the full picture, we've got to dig into what's been happening over the past few months. The company had its hands full, dealing with a whole bunch of problems, from supply chain headaches to changing customer habits. As a world-famous coffee joint, they're no stranger to facing challenges. Issues have been throwing curveballs at Starbucks. Let's face it, the world economy isn't exactly all rainbows and unicorns. People are worried about rising inflation, climbing interest rates, and the possibility of a recession. All this has made investors pretty scared, especially when it comes to growth stocks like Starbucks. And let's not forget the elephant in the room, the pandemic. COVID-19 changed how people do pretty much everything, including their daily Starbucks run. With more folks working home, those regular coffee trips took a hit, and Starbucks' bottom line felt it. But hey, let's not jump to any rash conclusions here. Some of you might be thinking, is Starbucks on a one-way trip down? Well, it's not that simple. Things might look a bit gloomy right now. It's worth remembering that the stock market is a complex mess. It can be wildly unpredictable, and things aren't always what they seem. Let's dive deeper into the matter, shall we? Consider this: financial experts often view drops in stock value as potential buying opportunities. This concept might seem unreasonable to some, especially to those who are new to the world of investing. When they see a plummeting stock value, their immediate instinct might be to sell. However, this is where the wisdom of seasoned investors comes into play. They perceive such drops not as threats, but opportunities to make profits. The reasoning behind this is quite simple to understand. When we talk about a company with a solid track record, we talk about a company that has consistently proven its ability to generate profits and maintain its position in the market, like Starbucks. This kind of company has a history of financial stability, management, innovative products or services, and healthy cash flows. Even when it experiences a dip in stock value, it's often due to transient issues, perhaps a bad quarter, a temporary market downturn, or a short-lived controversy. These issues, while significant, are usually not critical enough to bring the company down. Rather, they provide a window of opportunity to purchase stocks at a discounted rate. The beauty of this scenario is that once these issues are resolved, and they usually are, the company's stock value usually recovers. In fact, it often bounces back stronger than ever, bolstered by the company's proven resilience and the market's renewed confidence in its potential. Recovery results in a tidy profit for those who bought when the stock was at its low. The principle behind this is simple: buy the dip, sell the high. It's a basic strategy that seasoned investors swear by, a strategy that has the potential to yield considerable returns. Does the drop in Starbucks stock value present a buying opportunity? Several market analysts think so. They argue that Starbucks is a resilient company with a strong brand and a loyal customer base. They believe that Starbucks will bounce back from its current challenges, making now an opportune time to invest. Let's take a look at the chart for Starbucks. It appears to have taken quite a hit in recent days. Observing the chart, it's clear that it has plummeted considerably from its previous highs in the 100s. This could potentially be an opportune moment to buy the dip at the 70s. I can see it going to the mid-80s with any relevant news they might release. Of course, investing in stocks is never void of risks. It's a pursuit that comes with a notable degree of uncertainty. The market is astoundingly unpredictable. Stocks, bonds, ETFs, they all pose a certain amount of risk that investors must be ready to accept. One method to lessen these risks is through comprehensive research, A thorough understanding of a company's business operations, market position, and financial health can provide insight into the possible risks and benefits of investing in its stocks. Market trends, financial earnings reports, and economic forecasts all contribute to this understanding. Considering your financial goals is another crucial step in the investment process. If you're a conservative investor aiming to preserve your capital, high-risk stocks might not be the most suitable for you. Conversely, if an aggressive investor with a higher risk tolerance, you might be more inclined to invest in companies with volatile stock prices. Risk tolerance is another essential factor to consider. It's crucial to understand that higher potential returns come with higher levels of risk. Thus, you must strike a balance that aligns with your financial goals and risk tolerance. Now, let's switch our attention to SBUX. Despite its recent dip in stock value, the company still appears promising. It's important to bear in mind that a drop in stock value doesn't necessarily indicate a company is in strife. Sometimes it can present an opportunity for investors to purchase shares at a reduced price. At first glance, it might seem risky, but with thorough research and careful consideration, it could transform into a worthwhile investment. What are your thoughts on the future of SBUX? Could this be a buying opportunity for you? Ultimately, the potential for success lies in the patience and wisdom of making informed decisions. All for today. Thank you for tuning in. Don't forget to like the video and hit the subscribe button for more videos like this.